All right. Starting to have people jump in here. And if you've been here before, you know that I'll kill the first few minutes as people stream in from the live now email push. This is super timely actually for me. I just we've been doing it. If you've been active on the Sandhill side, I've been doing more. I've been doing a decent amount of late stage stuff alongside YC, which I definitely wouldn't YC investing and post batch investing, which I would definitely not call pre-seed. We can talk about valuations at some point during this conversation, but made a couple really recent pre-seed investments, and it got me super excited about the space again, which is just very different, and we'll talk about that more specifically. But really early is different early is different for different people in different contexts. You talk to late stage guys about early, and they're going to say it's Series B. Where this is the actually early stuff. So super excited to talk to Soso and Amit about all this. You've heard me before. If you're on the stream, you have some sort of context. But run Sandhill, we do this type of stuff on the media side, and we have a syndicate that we invest with. I think we have a thanking Walter slide, but maybe we don't. But Walter from Sacra.com, and we should have a thanking Walter slide, which we usually do. Sacra.com. I'll say it one more time, Sacra.com. Thanks to Walter for bringing us all together. It's always awesome. But without too much further ado, one of our first guests, Soso, and I'll have him pronounce his last name and before I mess it up. But he's an early stage investor, and he was founded a growth agency called Growth Pilots, works with some big companies that you've probably heard of, like Instacart, Zapier, and Gusto, before getting onto the investor side. And works, really early again on the pre-seed side, both scale and how to grow from early on. And then finally, Amit, there's somehow two last names in here, which is wrong. He'll advise us on his correct last name, which is Sudev, and is right on here on the left. But Earl Grey Capital, another Clearbit guy. We love the Clearbit team here at Sandhill. We're excited to talk about the investing side. We talked to one of his co-founders, who is still working is at HubSpot now, if you remember. And but now Amit is focused on the investing side at Earl Grey Capital. But they'll tell us all about that. I think I've killed enough time here, enough from me, more from Amit and Soso. And I'll get rid of these slides. And we're off. Hey guys. Sorry about the last name mix up on the intro slide. I don't know where. Or wait. So yeah. So what Vasudev, and then we got mixed up with the what's it called? Your Twitter handle.
Who knows? Vasudev though. That's. I'm pretty sure that's right. Vasudev.
Okay. Good. All right. Good start. I gave you guys very short intros in an effort to kind of get you up here quicker. Would love for you all to give a more complete one. Amit, if you're game to start us off, both from not just the firm, which everyone's interested to hear about, obviously in the context there, but what led you into the investing side.
Yeah, of course. First of all, happy to be here, and thanks for doing all this, and also thanks to Walter for helping set this up. So just quick background. So now I'm in Austin, Texas, but probably the main part of my career was being one of the co-founders of Clearbit, which sounds like there's some familiarity there. We basically wanted to build the API layer for data, the way Stripe did for payments. And, we were used by a lot of marketing and sales teams at pretty much every B2B SaaS company you know in some shape or form. Started the company in 2015. I was our chief revenue officer for the first 6.5 or so years. We were fortunate to have an exit last year to HubSpot, who's been an awesome partner. I personally fired myself in the end of 2020 as CRO. Kind of a miracle that I lasted as long as I did anyway. But fired myself. I was much more of a 0 to 1, 0 to 10 guy. And, I was not great at managing, 100 plus people, which is what I was being asked to do. And kind of by luck. And so, Alex McCaw, our CEO, and also co-founder of Clearbit, also had stepped down a few months after me. We were close with Naval Ravikant, who was an angel in Clearbit, as well as Jeff Fagnan. They helped set us up with a fund. Say, hey, if you guys want to check out investing, we love kind of active or recently active founders turn investing. Of course, AngelList is highly motivated to help more people do funds and get into investing. They helped us get started the first fund. Alex and I switched roles. I was more the CEO. And so we started Earl Grey Capital. And now we're on the second fund. And it's been a lot of fun. I'd say certainly there's pros and cons to investing versus building. We try to do a little bit of both at Earl Grey, but been running now a fund for I guess the bulk of the last 4-ish years.
Awesome. Soso, and I'm pronouncing your name right, Soso? I should have asked you before.
Yep, so correct in the last.
Oh, you want to know what? Hey, wait. I think from we're getting a weird feedback on maybe your AirPods, or if you're game to take those off, or just go straight from the computer. I think we had it before. Let's see how we do. That won't be not the first or the last time this will happen, so all good. Let's see. Let's try one more. It'll take a second to adjust. Now it's weirdly delayed. Are you getting the same thing, Amit?
Yeah, a little bit.
Let's do this. If you're game to
any better? Nothing.
No, it's we're hearing you, but it's delayed. Let's do this. How about leave and come back? You can just join the same link, and it should adjust for you.
Is that any better?
That is better. I don't know how.
Okay. I don't know what happened.
Crystal clear. Great.
All right. Okay. Good.
All right, we're back
sorry
on.
about that. But yeah, Soso is the correct pronunciation. Sazesh is my last name. Thanks so much for having me. Excited to be here, and thanks to Walter and Sandhill. I guess my quick background. Most of my career, I would say like the prior decade to me starting 43 with my partners, I built a growth agency called Growth Pilots. I kind of fell in love with this idea of helping founders figure out how to scale their companies. And so I set out to build this agency to be best in class at helping founders scale. We grew entirely by word of mouth, and just kind of based on the quality of work and hustle, we were able to attract some really kind of marquee names in the industry. All in all, we ended up working with like over 100 startups over the 8 years that I ran Growth Pilots. And we managed about $500 million in ad spend for, Instacart, Gusto, Zapier, and dozens of other well-known companies. And that was kind of my, I guess, like entree into helping founders, but that pulled me into angel investing. And that was when I kind of just got hooked on it, that my combination of, or rather passion for helping founders, and then figuring out this idea that there's leverage. I can, instead of just doing services for money, I can put money in, be helpful, and hopefully make money at some point in the future. So that's kind of I guess how I get started investing. I sold Growth Pilots. We had an exit to an agency called Wpromote down in LA. It was a good exit, and I was thinking about what was next. And I had been angel investing for several years. I actually did an AngelList syndicate via the prompting of one of my current partner, Dustin, at 43. He was at AngelList, or rather Maiden Lane Ventures at the time, which sat on top of AngelList and invested in syndicate leads. And he's like, dude, you should start a syndicate with your background, with your network. And so I did, and got to work closely with Dustin in doing that. And that was really when things just kind of like, I had this aha moment. I'm like, oh, founders want me on the cap table. I can be helpful. And I kind of found my groove. So once I sold Growth Pilots, banded together with Dustin and our third partner, Annabelle, and we decided to kind of go all in on this idea for 43. 43 is a little bit of a weird fund for a lot of different reasons. We don't really call ourselves a pre-seed fund. We really think of ourselves as kind of like an alternative to an accelerator. If you think of an accelerator like a Barry's Bootcamp, 43 is more like a trio of personal trainers. That's kind of the analogy that we give. Each of us make 5 investments per year, completely independent of one another. There's no group decision making. We find the founders where, amongst our own networks and kind of using our own sourcing, and then we each make independent decisions and work really closely with those founders to help them graduate to the next round. So we're mostly investing in this like very, very first round before there's a product in market. Usually the round is like 500K, maybe up to $1 million. So we look a little strange from that perspective, and I'm excited to kind of dive into all the dynamics of pre-seed and kind of where we sit in the market. We're on fund one. And yeah, we're generalists, kind of through and through, really fall in love with founders, back founders who are very high conviction on a specific problem space and have some unique insight around that problem. That's us in a nutshell.
So there's some good, there's a bunch of stuff to get into, and I know we have a list of kind of topics to run through, but there's two things that you guys said that I think come into the same topic. 0 to 1 or 0 to 10, Amit mentioned, had that like sound bit, and like there's, I think, something to discuss there of like, and then the same thing of difference between an angel and a pre-seed fund, right? Like, but all around, like, and actually, you want to know what let's get we'll get Walter involved with his first question. Early, or just early is really insightful from Walter. But I think that to define some terms a little bit, again, like, I think the later stages, like the letters, can get a little bit more jumbled, but pre-seed seems pretty definitive because it's just as early as you could possibly be. But how do you guys think about defining like pre-seed specifically? I mean, I'll throw it back to you, and then we can get it from Sozo.
Yeah, I'd argue that it's not that simple. You're seeing terms like inception round, you're seeing incubations, you're seeing accelerators, you're seeing just a first round in. For simplicity's purposes, I think of it as the first money in. And, sometimes that could be called friends and family. That could be called a pre-seed. Sure, you're seeing situations where, some really highly regarded second-time founders are raising $10 million or even much more. I guess technically that's a pre-seed, although the valuation probably wouldn't say that benchmark-wise. But for simplicity's purposes, I think of it really as the first money in.
Got it.
Yeah, and this is funny. I was gonna agree. I was gonna disagree with you, Adam, and agree with you, Amit. I think pre-seed is the most confusing of all of the stages because for these reasons. And pre-seed's a new thing. This is like less than 10 years old, right? Pre-seed kind of came to be because there was this concept of a seed round, and seed rounds ended up getting much larger, and then it left this gap. And it's like, okay, well, what do you do before the seed round? And so pre-seed was just kind of this term that popped up. And now pre-seed, I think, is like, it's confusing not only in definition, but also pre-seed's kind of bifurcating. And, Amit touched on this. First of all, like, is it the amount you raise? Is that what determines if it's a pre-seed round? Is it the valuation? Is it whether it's the first money in? And you'll get different answers depending on who you ask. And there's not consensus amongst the definition. But that's one side of the complexity. And the other is, okay, well, what does a pre-seed round look like? And so I think that there's like 3 buckets of pre-seed rounds. And I think Amit kind of alluded to these. There's this, if you want to call it inception or idea stage, but I actually think of it more as a function of the founder profile. So like, let's call it the first 500K, maybe up to $1 million. This is where accelerators play. A lot of angels play there, and funds like 43 play there. These are credible founders who probably aren't like super well networked. They're credible founders with an idea who probably haven't achieved much progress yet. They can pull together a 500K to $1 million round usually. Then the next jump is like what I would consider like classic pre-seed, which is probably like $1 to maybe $2.5 million. That's usually it's credible founders who are probably pretty well networked, who have with an idea. So they can go and do that. Or maybe founders who are credible, who aren't super well networked, but they've achieved a level of progress that allows them to raise that round. So that's why it's confusing. A pre-seed fund, I think by definition, people are like, oh, that just means I can go with an idea and raise money from them. And I think for some founders that's true, but for a lot of founders that's also not true. And so it's kind of complicated. And then there's like the pre-seed rounds that almost look like seed rounds, which these could be 5 to 10 million plus. These are exceptional founders who are incredibly well networked, who can raise on their name alone, and they do. And those very rarely are done by pre-seed funds, right? Those are typically done by either like the multi-stage tier 1 funds or maybe a seed fund who has proprietary access to that founder. But it's rare that you're going to see pre-seed funds leading those $5 to $10 million pre-seed rounds. So that's kind of like, I guess, the landscape as I think about it.
Yeah, and that makes a lot of sense. And I think maybe I'm out of practice in the earlier stages. It all rings a bell.
Yeah, it's really a function of like, again, it's like, where are you investing, right? Are you investing in a company that's post product market fit, that has customers, has revenue? Or are you investing in a company that isn't even a company yet, but it's at, it's pre all that, right? It's really kind of like, are you an investor who's good at, like Soso alluded to, really making a bet on the founder of the market, the point of view, versus, are you looking at financials, traction, seed/series A? And I think that's at least intellectually how I think about it, of like, okay, this is pre-seed because this is the stage they're at, whether they're raising 10 million or 500K.
From the fund perspective, I think that this is different from the angel, right? Like, and I would like to get your opinion on it from Soso and Amit, where I think we're probably in similar situations, making the decision to move from angel investing. You were both post-exit, well-networked. People want you on the cap table. You don't need a firm necessarily to do that. What was the decision and the difference maybe from the angel investing that you did? And now, as you have LPs, you have a fund structure. One, the decision to do that, and then maybe pros and cons, things that are different in the decision making. So
yeah, for sure. Yeah, I think it's interesting because as an angel, I had like a little bit of an identity crisis when I switched over to like 43. As an angel, I was known as like the growth angel because I built growth pilots, and everyone's like, "Oh, growth super well," and that's why people wanted me on the cap table initially. But I did this interesting transition where I'm like, when you need help with growth, you're not usually at the pre-seed stage. You're raising a seed round, maybe Series A. Like, you're kind of starting to see some early signs of product market fit. And so my style and stage of investing, actually, there was kind of a moment where it morphed, where I wanted to keep going earlier and earlier because I was enjoying the relationship I was building with founders, how I was helping them separate from growth. And that was kind of the catalyst for me jumping full time. I found my partners, Dustin and Annabelle, who also love investing at that stage. We were like all three doing the same work independently, but kind of collaborating. And we're like, we're all onto something here. There's very few people who want to invest at this hands-on, like raw stage where there's nothing but an idea and you're investing in founders. And so that was the big catalyst for me, having two partners who like-minded, who wanted to do this work, but where we could all respect each other's decision-making and independence and have that trust. And so that was kind of what got me excited to start 43 with my partners.
Yeah, for us, and more, a little bit more so Alex than me, but we'd done, I think, a pretty good job of angel investing, and certainly we saw a lot of really interesting deals even while running Clearbit. We were so laser focused on Clearbit, it was sort of not something that we were really capitalizing on. I actually kicked myself when I think about so many great companies that were like, "Hey, we love your product, we love you. You guys know a lot about growth. You should angel invest." And we're just like, not really interested. And that's like Monday. I mean, Notion, Airtable, so many companies who are our customers, and we're just like, nah. But some we did, but for the most part, we didn't have liquidity, right? I mean, we didn't sell Clearbit until 2023. And as I mentioned, we saw a lot of deals and believed always that investors should be founders and operators. But we always kind of sneered a little bit at like the non-technical VCs who would love Clearbit and want to invest and like didn't know how to use our API. So we always believed that like the future is this. And then when we had the chance to do it, again, we're very fortunate that we basically were offered to have a fund anchored by the other folks I mentioned earlier. It made sense to do it. It made sense to do it both from a capital standpoint. We were now no longer in full-time roles. And if we wanted to do it, we wanted to play to win. So we wanted to have actual check sizing. We wanted to actually do it. And it seemed like a fun adventure to do and build something else new, at least for me. So yeah, we kind of did that. Now it's funny, in retrospect, people have asked me like, well, if you sold Clearbit, would you angel invest or do a fund? Honestly, it'd be a tougher call. I mean, now I'm really happy doing it. And I'll probably do at least one more fund, but we're not kind of like, we very much are intellectually honest saying, hey, there's a lot of benefits to angel investing versus a fund. Again, I'm really happy where we are. We have great LPs, but we're a small fund, right? I don't want to do a large fund. We're not playing a game where it's like raise fund after fund and try and scale AUM. I think that is fraught with just a lot of challenges that we don't want to deal with. So very much there's a lot of validity to both.
Just to stay on the fund side, and then we'll get into I have questions about sourcing that we kind of talked about a little bit, and then competitive landscape that you guys touched on as well. on the fund side in the pre-seed stage, people talk about management fees and venture, like, oh, VCs getting rich on management fees. That does not apply to pre-seed early stage because the funds just aren't very big. Like oftentimes it's the opposite. Oftentimes it's the opposite where where there's not a ton of money to keep the lights on, or you're trying to pull those fees forward to go from fund to fund because they're just much smaller. And Amit, you mentioned it, right, where you have to make a decision to not go bigger, even though you probably will get pulled there, right? If you do well, people are like, oh, they want you to follow on, like, oh, why don't you raise, why don't you do the A? Why don't you do the B? Like, why don't you raise these bigger rounds and stuff? How do you guys think about that, like the sizing? And then the last part I'll throw into it, very long timelines, very, very long timelines. Like, how do you think about those two things? How often does it come up? Does it not come up in your mind?
Yeah. We've thought about it so much just because, again, we're on a second fund. We probably could have raised a lot more. And folks are asking now, do you want to do, we have over 100 companies portfolio. So there are a lot of opportunities to do that. But I've said this over and over again. And, we're lucky to have our anchor in this fund is Sandana Capital. I think they're probably one of the best or most well-known fund of funds out there. They have, again, really data-driven proof of what works, what doesn't work. And, we don't pay ourselves. Like we use some of the fees for like legal and hires, but we don't take salary. So we're like, this has to make us money from actually investing. And I think unequivocally that, fund size is your strategy. And so you've seen so many VCs get into trouble where they've done well as angels or small funds. And then all of a sudden they try and, they need to size up because if you have a $50 million fund and you're early stage, you pretty much have to lead. And get very meaningful ownership. Well, if a lot of your deals or winners are like, just participating into a round, like you're not going to get those anymore, or at least not invest in those in the same way. And so your strategy has to adapt. Now, whether what your LP pitch deck says is different than reality. And I think a lot of times people actually just end up leading much lesser deals than they sort of raised on. Or maybe they're kind of saying we're going after non-consensus, but either way, it's somewhere in the middle. And that ends up not leading to great returns. But again, that's sort of the game you're playing. If you're like, hey, I need to get to this fund size to have a certain amount of fees and salary. Like, again, I think it just doesn't, it's not quite like as pure of what it should be. And so, I think ultimately a small fund dictates your ownership percentage. It dictates the type of check you're going to write. Based on the composition of rounds, you have to understand intellectually where you can get in, where you're going to get deals from. So, without question, I think we're better at Earl Grey at having a sub $20 million fund with what we do than if we were to have a 50 or 100. Like we wouldn't be as good. And I'm very comfortable saying that because it's just simply true.
Yeah, a lot of interesting things to touch on there. I think on the management fee piece and the fund size piece, fully agree. I think this was when Dustin, Annabelle, and myself were sitting down, like, kind of putting together the thesis and the vision for the fund. Well, first of all, we all knew going into it, like our style of investing, we each wanted to be very measured in pace. Again, doing like 4 to 6 investments a year, leading those rounds and being very hands-on. And we wanted to stay at this first kind of 500K, that's kind of where we live in terms of the round size. And so by definition of that, like the math doesn't work. You can't have a big fund and pull that off. And so we all had some kind of liquidity event that allowed us to kind of to take this risk on to do this. And we take like very, very, we're a sub $20 million fund one with 3 GPs, right? So you can do the math on that. It's like very, very meager. And that's fine. Like we were willing to take the risk. We want to be aligned with our LPs long-term. As we think about, what the next fund might look like, we need it to be sustainable to the point where it doesn't break our strategy, but where it keeps the lights on. And so, but I fully agree. Like we're not in this for management fees or to play the AUM game. Like we've always said, like this is probably again why we look really weird in the market. We're going to keep our pacing of capital to partner consistent from fund to fund. And so the only way we'll grow AUM is if we add more people to the partnership, and we'll kind of replicate the person, like add a new personal trainer to the 43 umbrella.
Yeah. No, it's super interesting. And It's great. I mean, I think that's hard and that's crazy. And I think it's an important thing to bring up because it's very much away from exactly what I talked about, the rich off management fees kind of vision of a VC, where oftentimes it's a lot more, there's a lot more of a starving artist kind of vibe at the pre-seed stage, right? Like not actually, you guys have both, had exits or whatever, but there's also a bunch of, it's such an important part of the ecosystem, and angels, I think, are obviously really important, and that's where it sits. But then the professionalism that actual pre-seed funds bring in are really important, and in a important, like, also outside of the YC crowd, which I want to get into. And I mentioned the YC aspect of it, which maybe I'll leave to the end of this kind of sourcing conversation. How do you guys think about sourcing? How much of it has been, I think, and this is maybe an emerging manager kind of trope, or something I think a lot of people run into. You're raising your first fund and it's like, I have the best friends. They're all building the best companies. I know them from wherever. And that's awesome for like a fund one, or awesome for, initial strategy. But then the LP's like, okay, so what happens after you invest in all your friends? Like, like what's the next round? What's the next batch look like? What does fund two look like? Things like that. And then I think that what I've seen from emerging managers, the one that succeed, are a lot more systematic about it. And I think that, Soso, you touch on your on the pacing aspect of it, which I'm sure you guys talked about a lot. So I'm interested about that. And Amit, obviously, you talked about you guys have been in market for a long time, but it's a real fun with LPs and stuff. It's not investing. I think you guys are past the investing in your friends part now that you're in fund. You're a few funds in. You guys want to touch on the sourcing kind of strategy?
Yeah. So it's so funny because sourcing, I have like two minds, and this is like probably our number one debate internally, is like, do we want to build these like unified sourcing engines, or do we kind of each have our individual style and lean into those? And so again, because the way that our fund is structured and the way we operate, we're three individuals kind of running our own playbook. And so my personal belief is that sourcing is, at our stage, we have to catch people at a very short moment in time where they're ready to start a company. They're starting a company. Once they ship the product and they're kind of too late for us. So we need to capture them at that moment in time. So we need mind share with founders at that stage. A lot of it, though, like my personal strategy and belief is this stuff is very idiosyncratic, but it's very, very word of mouth driven. And so what that means is showing up for founders, doing good work, and founders know other founders or prospective founders because people come to them and say, oh, I'm ready to start a company. Like that's kind of how Silicon Valley works. And so, our goal, and I should say like me specifically, my goal is like, I want to be in those conversations when someone's going to a founder that I've invested in, be like, I'm thinking about starting a company. I want to be the first name that like, you got to talk to Soso. That's like my version of NPS, is like, that's how I know I'm doing the right thing. And so I'm a huge believer in client service. And that was like hammered into my head building growth pilots. Like, you do what you need to do to keep the client happy and show up for them and be valuable and helpful. And that's kind of like my source, my personal sourcing engine. And Dustin and Annabelle each have their own. But we have thought about like, do we want to put an application out there? It kind of goes against this like three-pronged approach that we have, but we've debated this a lot internally.
Yeah.
Yeah, I would say to kind of echo the point I made earlier, I think it all is a function of your strategy, right? If you're a small fund, you can be more collaborative. If you're a large fund, it's harder. To Soso's point, if you're super early, it doesn't really make sense once they've already shipped to go outbound to companies that are, have a lot of traction. I mean, it's all a function of what you're doing. And I don't know if there's one right answer. Certainly, I would say that, we're pretty data driven. Clearbit was a data company. We've done, again, over 100 investments. So I tend to take a look at, okay, what are the patterns of what's resulted in great investments for us versus not so great. And the conclusion I think I've reached at this point is that it's a bit of a cop-out answer, but it's that having multiple channels is actually the best thing, and having multiple ways to see stuff. Because we're in a game where, you could see something from network, you could see something from a co-investor, you could see something from, an open source product you like, you could see something referred by a founder or by somebody coming from one of your companies. And so our kind of what we do, I think, fairly well is have the ability to kind of rapidly ingest a lot of deals from a lot of different places and field them. And again, that helps that we have a few partners, we have folks on the team, but we like to see things from a lot of different places versus being like, again, this may work better for an LP pitch deck. I don't think it works better in practice to say, okay, you know, I go and speak at the local high school every week and I've got an absolute domination on anybody who comes from there. It's like, well, congratulations. You're probably not going to have any meaningful PPI from it, but hey, it looks great. You know, you're the first check in to those founders. So, you know, I think a multivariate strategy is actually very important. But again, because we're, you know, we can be a check in and then bring in a lead can bring us in. We've seen a lot of both, or even just a party round. Like, it all has to do with our fund size and our strategy and our sizing. We want to make sure we have the surface area to capitalize on all those things. I say for us, you know, to Soso's point, I mean, we don't get into deals because, you know, we have some big following or this or that. That's not really our shtick. It's like, look, if you're raising a round, you need, you know, you should have these types of folks on board, maybe some amplification, maybe some kind of hardcore operators, and, you know, maybe a lead. We fall into the hardcore operator bucket. And yeah, a lot of that comes from, again, especially second-time founders, technical founders. That's more where we live. And yeah, those folks are not, you know, the ones who are going to be like enamored by, you know, Instagram followers. They're like, oh, you guys built a company we respect or want to do things like, and, you know, we've heard great things from other founders. Maybe they are a founder we've already backed. And like Soso said, I think that comes just from a track record of both as a builder as well as an investor, just doing right by founders behind the scenes. It's not shiny. It's not, you know, again, doesn't work as well on an LP pitch deck, but it's reality. And it's what actually compounds to get, you know, referred or recommended into something that's probably a pretty tight allocation.
Yeah.
Yeah. And just really quickly, I mean, I agree with so much of that. And the idea, and it's like, it's kind of a shame, but it makes sense. Like, the squeaky wheel gets the grease, and that happens so much. Like, you know, you have someone who's built this great brand, and I'm sure they see a lot of great deal flow, but like, LPs really, really buy that, eat that stuff up. And it's like, you have something you can point to and you have this big following. Yeah, we're just more the like, roll your sleeves up, do the work, and like kind of build it more bottoms up. And that's just stylistically how we are. And like, there's certainly pros and cons, and I don't want to knock anybody, because there are people who build great brands and who are great investors, but man, that's it's just kind of a different game.
Yeah. No, I mean, it's super interesting. And it's a relatively new thing. Like, you know, the loud VC world, you know, the VC thought leader, which I think Andrew Chen he kind of wrote the book on the Twitter following to big VC kind of path. That then I remember hearing a VC kind of complain about it, of like another like similarly large firm, similarly large VC was like, I didn't want to be on Twitter, but now I have to be on Twitter because like that's how the game's getting played. And so it's funny how it's gone. But in terms of one of the things you guys mentioned about these network founders, and in a situation, right, where you guys are sourcing through, just to focus on that channel really specifically, a founder maybe that you've worked with or they know you, and then somebody's talking to them like, hey, I'm thinking about starting a company, and they go, oh, you should meet Soso, you should meet Amit. Both of those come in that kind of networked category. And then I think that you mentioned, you know, putting an application out there, and then there's the conversation though, and you both mentioned it, of like the accelerator world, of where, and YC being like, you know, the dominant force there, of which I feels more. I was just having a conversation yesterday with a friend about this, of it feels like less networked, right? It's more like, you know, here's the front door, knock on it. But if you're already in, like, maybe you don't need to knock, you can just talk to Amit or talk to Soso. How do you guys think about your role at the pre-seed stage next to, you know, a YC? And is it do you compete against them? Is it collaborative? Is it just different fits? You know, what's the conversation there?
Yeah, we squarely do. Like we do. I mean, we compete with Accelerate. We are an alternative to an accelerators. We're investing on similar terms, similar amounts of capital. So like through and through, we are. And this is the interesting thing. The reason we've kind of debated an application, like I've made several investments that have come in from a cold inbound to me, not someone who's been known to the network, just somebody credible who has come through, who I've evaluated the founder and, you know, spent time with them and got excited about it. And so we're seeing the, like, I guess, simulation of an application take place already. We don't have a full-blown application. And so, but yes, I think like we are very much, we fit into the category of like the term that we are an accelerator stage fund. It doesn't really exist, but that is like where we live and the kind of like the work that we do. It's just more one-to-one hands-on versus a more, I guess, batch-based mentality and approach.
Yeah.
So our fund, to be clear, does both pre-seed and seed. So if we're doing a seed deal, that theoretically could be a post YC company raising, at a, $15 to $30 million valuation. And that looks like a seed they've already raised from, YC, maybe even something else. So we do those. I'd say generally speaking, we do with this fund, we're pretty early in the fund. We've only invested, like $1.5 million. We will end up doing more pre-seed, and I can get more into why we've slanted more that direction over time. There's a lot of reasons for that. But yeah, to Soso's point, if we're going to do pre-seed, we want to be part of the first round in. It's sort of zero sum. It's like either it's an accelerator and it's either alongside them or at similar terms, or it's a different round together. Generally speaking, I'd say at least our deal flow and bias has been more towards the folks who aren't going to accelerators. They're more folks who, again, especially if they have a track record, they're technical founders, they're kind of just doing around a first round. For example, we were the first check in Crew AI, and then Boldstar came into lead. The most recent investment we did, a 4 VC led, and then we came into that round as second or third biggest check. So those are not they're not doing accelerators at all. They're kind of more just like mini rounds. On the topic of YC, though, I think, again, there's no right or wrong answer. I actually think YC and accelerator models in general are great because they're excellent terms at some meaningful scale of company. And that's kind of a recipe for success, at least in a high volume deal capacity versus saying, hey, we're going to back 5 companies out of this pre-seed fund and we're going to follow on every round for them. I think that's, there's a lot of luck involved there. You could go 0 for 5. So I think that generally speaking, they're great. Just what I found though is, like if I were to start another company, I wouldn't even think about doing accelerator, right? The terms just aren't good enough. So it depends, but that's if I was coming out of college, like I went to Stanford for undergrad. I know there's a lot of Stanford kids who are like all in on YC. I bet that's probably a pretty good denominator set, right? So it's not a right or wrong answer, but yeah, we kind of don't do as much there. So I guess it's competitive at pre-seed as well.
Yeah, and on that point, that's a really good point. I think on the whole, I think if you look at founders who go through YC or an accelerator in general, they tend to skew younger, less experienced. We tend to really like founders who have some operating experience. Most of our founders are first-time founders, but they have they have deep expertise in the specific problem, and they have several years of working experience. And so that's where like we kind of offer an accelerator like product for those type of founders. And like to Amit's point, some of those founders don't want to go through an accelerator. They don't need like a batch-based kind of cohort and camaraderie and kind of the pressure and the timelines that come with that. So yeah, there's like different things appeal to different founders. I think that's well put, Amit.
Amit, you mentioned the seed and transitioning, further into pre-seed. Can you talk about that a little bit more? Like what like pushed you, I guess, doing both, and then maybe pushing even earlier?
Yeah, of course, for sure. I think one thing that we already felt, and I think AI and LLMs have sort of exacerbated, especially at least in the realm of pure software, is that we always, in the last 3-4 years we've been in VC, we always found it kind of crazy that, you'd see XYZ sort of, relatively milquetoast software at like 200, 300K in ARR. And they're like, all right, we're like this killer. And by the way, we grew 10X last year. Again, you're at 200K ARR. It's like 10X growth is not that impressive. It's like, hey, we grew from 20 to 200, and then they get valued at a seed evaluation at like, 30, 40, especially kind of in crazy ZERP times. They get this huge valuation. And it's like to be at a couple 100K in ARR is so unfathomably far from an IPO type like revenue. It was crazy to see just like folks sort of think that growth rate will just, again, it's almost like you take somebody who's looking at like an Excel sheet and being like, oh, this is a company I now want to bet on. And, that's maybe reduced a little bit, but I think AI has probably made that worse, where it's like, in my opinion, it's never been easier to build a 0 to call it $5 million ARR company, but maybe never been harder to build a $500 million company, at least in pure software. And so, but that's what you're betting on. So in my opinion, seed is kind of like this dead zone of like, well, especially the ones that are kind of fast growing and relatively buzzy. It's like, well, you're going to get a valuation that I think is just a bad EV. It's like a bad EV for what you actually have to get to for that to be worth it, right? At a multi-billion-dollar level. But you have some traction, you have some heat. So, that's what it is. So I think just in terms of pure returns, Pre-seed's the place to live. It's really the only place you can get kind of the 50xers, 100xers multiples, right? I mean, maybe not if the first round in is at 50, but categorically, I just think that if you invest at, 5, 10, 15, you at least have the chance to get there and have those returns as an early investor, which is, all the data shows that's where the returns come from. So from my standpoint, there's a math element to it. There's an EV value element to it. And then lastly, I'll say that I think, again, at least in pure software, I think that the floor has been raised, right? Like, where do a lot of pre-seed companies, where have they historically had mortality? It's like not having enough money to get through a few iterations of product market fit, or get product out there, or get to revenue, or get to kind of an iterative point. Whereas now the costs have gone down so dramatically. If you're backing somebody who knows how to ship shit and get things done, like, they can get through that much more leanly and faster. So I think in some part the floor has been raised as well. So those are kind of my general thinking of why it makes sense to try and do more kind of first round checks than maybe we've done in the past.
Yeah, and you've been like distinctly pre-seed the whole time, correct? And for reasons similar to that, I would assume.
Yeah, I think it through and through, like that very first $500K to $1 million. That's really where we're focused. And I mean, I think that when you do the math on it, like the portfolio math on it is quite beautiful when you're looking at, if you can get into a company at sub $10 million and you build like a healthy portfolio of companies that have you look at the portfolio math of something can end up becoming worth $1 billion plus outcome on a small fund where you have meaningful ownership. Like it's a pretty nice portfolio construction. Yeah. But we didn't like derive, that's not like how we arrived at like, okay, we're going to model everything out and that's going to be like where we invest. We invest in this stage just because like this is kind of how our style is as angels, how we were operating and where we wanted to live is this like very first kind of putting founders in business stage. Everything else kind of followed from there. We built a model and like, okay, well, what kind of pacing makes sense if we're going to do this? What does the fund size need to look like, et cetera? And that's kind of how we backed into everything.
Amit, you mentioned pure software. I think that, there was a question on the sheet that we talked about before. Like, I think that this type of investing lives in, the software space because it ultimately is a small amount of, like, it's not the capital intensive, like hardware is taking off here or whatever. And there's just different costs associated with it. So there's a question there about, the pure software focus, and you feel like that's the like real pre-seed and kind of it has to be in a lot of ways. And then there's a follow-up conversation that, like you mentioned, the AI stuff of how pure software has changed that I want to dig into a little bit more. I mean, you mentioned specifically, right? Like the easiest time ever to get to 5 million, the hardest time ever to get to 50, right? Or so I guess to encapsulate that, do you think of the types of pre-seed investment that you guys do as being pure software? And then how do you think that's changed in the course of, the last few years, really?
Yeah, it's a great question. I do think that by and large, pure software, I mean, it's what you'd call kind of conventional SaaS, right? It's an app, maybe it's an API. It's just kind of, again, really high margin, pure software products. They don't have hardware. They don't have a lot of upstream costs. They don't have a lot of kind of fundamental COGS every time the product's used. But yeah, that's kind of a general term. I'll touch on the hardware thing in a second. So just in general, I guess I haven't talked about this. Our thesis, I should say, we are a specialized fund. We like to back with Earl Grey, and we've gotten more specialized over time actually, because it's where we believe we have the best investor market fit. So we actually don't do as much. Ironically, Clearbit was like a sales and marketing tech app. We do very little of that with this fund. and I can touch on why. But we actually tend to focus more on sort of developer first tech. Two types of companies. One, like the OpenAIs of the world. It's like, have you built something actually pretty complex and now made it very easy for a developer to then build on top of, ideally to create new value, new products, new technology, new companies. We like companies where people see it and they're like, oh, I'm going to stop what I'm doing and go start a company on this. So it's kind of like GDP and innovation creative foundations we like. And in this fund, we've backed Crew AI, which is doing that. Archetype, which is doing that. Crew AI is like, it's basically a open source agent platform that, gazillion people are building companies on top of now. And then the second type is more like Clearbit, Plaid, Stripe, where it's taking something that's Twilio that's actually pretty complex to do, and then making that kind of very easy for you to then bolt in like a Lego. And Stripe, those payments. For Clearbit, that's data. And ideally, the key there is the upstream stuff has to be complex. Like part of why, Twilio is successful or Clearbit is successful is nobody's going to go build that internally. They may try. Well, I should say now it's probably easier to build Clearbit internally than it was in 2015. But the point is that it's not just a sort of quality of life thing. It's a actually important technology that is then made really easy to build on. So generally speaking, whereas what's not that is like, okay, here's a note-taking app, or here's a yet another kind of sales tech. I mean, when talking about kind of pure software, that's more what I'm referring to, the kind of very high margin stuff that at this point in time is fairly low cost to build. That I think is the game has changed. Whereas if you look at the last 10 years, you can point at a lot of companies that built companies that you kind of just get on a path to ARR and you scale and you hire sales and you do all these things that I don't know if that playbook is going to work any longer. What fundamentally is valuable about this company, whether it's their tech, whether it's their distribution, whether it's, what's acquirable, right? Like at Clearbit, we kind of had to face those questions when we went through an acquisition. It's like, hey, HubSpot makes, we were at 40 million ARR when we were bought, that's like a weekend for them, probably less. So it's not, just because we were valued that way by VCs, it's like, what is fundamentally valuable what this company's building? I actually think hardware has a renaissance for largely that reason. A lot of SaaS is kind of everybody's fighting each other. It's great for buyers. It's like an amazing time for buyers, but there's going to be even more than ever, right? Companies will be able to build SaaS internally with in 5 minutes. Production apps will be able to create it by a long tail of individual kind of solo creators within, hours. And for hardware though, it's not true. They need capital. VC actually makes more sense for them than it does somebody saying, hey, I want to build a note-taking app. I'm going to raise VC. That actually doesn't make that much sense anymore. Whereas if you're building nuclear fusion, it's like, okay, you probably should be raising a lot of VC over and over again. So in a lot of ways, those make the most sense as a pre-seed deal.
So similar on the pure software thoughts. I think there's a lot in there. Obviously, it's
I'll sum it up. Well, for us, we're more agnostic and opportunistic. I think the way we think about the world is we want founders who can convince us what they're building, that there's a venture scale opportunity to be had, that they're the right founder to do it, and that right now is the right time to build it. If those three things, like those are kind of if you really distill everything, the way that we kind of make decisions and again, stylistically, maybe different between us three, but those are the three things we're looking for. Is there a venture scale outcome? Why are you the right person to take it, to solve this problem? And why is right now the right time to build this? That's kind of how we think about it. And so now to put that in like industry context, yes, we do a lot of software. Like I just did a robotics hardware company like earlier this year, first time doing that. But like, again, the founder was able to convince me of the opportunity, very credible team. And surprisingly, like crazy capital efficient. They raised less than $1 million and they built a walking robot in 4 months. And that's a testament to like team. And again, that's like team. But you look at the cost of all of these things, just like like the renaissance happening in hardware, the cost of software and cloud computing and storage coming down so much. Hardware is going through a similar renaissance with component costs coming down. And so you can actually do a lot with very little capital right now.
Very cool. I think, as we get in, we're kind of, towards the end here with 8 minutes left. And as you guys think about your investing, and I guess maybe advice and maybe interesting kind of like earned secrets that you feel like you've come across over the course of your investing, And maybe one would be, I think, very interesting on the founder side, right? Like what you find yourself advising founders on in the really earliest stage about, how they're approaching things, maybe any themes there. And also I think, and we mentioned this before we got on, a lot of, angels in the group, a lot of like people in the audience on the Sandhill side, and I know on the Sacra side as well, who want to be better investors. And I think that you guys are in a good position to advise on, maybe what you would advise to an angel who's thinking about putting their first money into it, like what's a key pitfall or a great thing to head towards. Amit, do you think?
Yeah, I guess there's a few questions there. I'd say advice to an angel, I would say would just be, like think with your head and your heart, right? Like if you love a product, okay, well just ask yourself like, why I happen to love this product, and that could be an important reason to invest. Clearly it means they're doing something right, but just ask yourself like, does that alone make this a great financial investment opportunity for me, right? If for example, they're going to go bootstrap all the way, or they're kind of looking like a certain direction, and you understand that, like, like, do you care about a return? If you're thinking about a return, work through literally the path of where that would come from and how. Spoiler alert, like just because somebody loves a product does not mean that the equity is going to be worth anything to you or anybody, right?
Yeah.
There's going to be a million companies that people like that the equity is worthless. So if you're supporting it, right, is it charity or is it like, are you actually doing it like an investment? And again, both are fine, right? I think a lot of people invest because they love something, and that's fine. Just know the game you're playing because it's very illiquid. And then on the earned secret side, I'm not sure. I think probably not the number one thing, but one of the things I find myself talking a lot about with founders is if they want to raise, like just make sure like if you're going to play the game, like understand how VCs tick, how their model works, like these things I wish I knew when we raised. We didn't raise a ton of Clearbit, but sometimes it was really easy, sometimes it was hard, depending on how the company was doing. But if you're going to do it, like do it to win. You kind of can't go half in, half out, or don't do it, right? Or kind of set yourself up to play different. So it's kind of like just understand your stakeholders in any context, just like you would understand a customer, and then be deliberate about that strategy.
Yeah. On the angel advice, I think, again, assuming you're kind of investing pre-product market fit before there's really much traction, it really just comes down. I kind of like the idea, think with your heart, think with your head. You're backing the person, you're backing the team. Just know, like, it's going to take 10, maybe 20 years for this company to have an outcome, if at all. And the product might change, what they're focused on might change, the founding team might change. You're really kind of backing the core founding team and the CEO. Like, frankly, that's usually kind of who you're underwriting against. And so that's my advice. That's the way I invest, is just looking at people, thinking about the long term of like, can this person can they be a leader of a company that could be a monumental company? And do they have what it takes to get there? And that changes, right? People have to adapt. You have to start out by being super scrappy, move really quickly. And then you have to, like, can you attract top tier talent? Can you go out and fundraise? And all right. And now you're going to get to this next phase of the company. Can you kind of handle all the things? So is somebody adaptable? And these are very soft tissue things. And so I guess it's like the other side of the coin for the other question you asked, like, what's the advice for founders? I don't think it's an earned secret, but it's like, if you think about why would somebody make an investment in you, a fund, an angel, it's like, there's a certain way you need to present yourself. You need to show up. You need to be polished. You need to know your shit. You need to know the market that you're operating in. And there's just these certain things. And then some of it is just soft tissue. You're not going to click with everybody. There's some investors who you're just like, you can have all the right answers and just like the vibe's not there. They don't think they're going to work very well with you. And so some of it's luck, some of it's vibe. But there are a lot of things that I think founders can do that they don't do. I can't tell you the number of just like even sloppiness and just like in the pitch deck, when you have typos and you have like sending a cold email and it's like addressed to the wrong person, like these small things, like attention to detail, that's like, I'm a stickler on that. I believe that attention to detail is like a very big determinant of how somebody carries themselves, how they operate professionally. And that's me, and that's my personal style. some other people might not care about that. So it's pretty idiosyncratic. Yeah.
To founders too, I'd say, I guess GPs as well. It's like the sooner you realize that life isn't fair, the better you'll be, the more successful you'll be. Because I wish I was 7 foot and played in the NBA, but it's like, hey, that's life. But a lot of founders are like, well, I saw they did a round, so why couldn't I? It's like, you don't know why. For all I know, they, their godfather was the person who founded the venture fund. Like, you just don't know, right?
Yeah.
And so to think that it's some scientific process when in reality it's not, you're just being naive. Not to mention that there's so many other companies that look the same. For all the time, right? We see folks be like, well, I'm a non-technical founder and I want to build something, but I need to raise money to hire an engineer. I'm like, why would I back that person versus the CEO who already built it? Right? The meeting after this is the person who already made it. Right. So it's kind of like, understand reality and be self-aware. Now, obviously, a non-technical founder go raise, and there's a lot of ways to do that. But don't be naive, right? Don't be naive about the way the world works and the way that things get done. And again, same with customers, right? It's better to who said it? I guess it was Andy Grove. It's like the first to reality wins. It's like same thing applies.
One question that I wanted, and ultimately maybe it's a good thing to wrap up on, is and the word vibe got thrown in there by Soso. What's the vibe in the pre-seed kind of sector that you guys are hanging out in terms of like the types of founders you're seeing, general excitement? Obviously AI is a big thing, and like there's a paradigm shift kind of happening there. There's a hardware renaissance that Soso mentioned, but then Amit also mentioned this ability to get to 5 million easier, and some people who are just kind of out on the VC game, like that was a storyline for a while of people like, I don't care about VC treadmill, I'm gonna launch this app, get to 5 million ARR and like be rich. Like what's when you take a sweeping comment, right, of like, when you look out, more exciting, less exciting, the same?
I think more exciting. I just think the number of opportunities to build have just exploded. And, I think generative AI has played a big role in that. And I think like one good indicator, like YC doubled the number of batches that they're doing per year. The amount of demand for this early round and people who have capable builders who have ideas that they want to build companies around is that it's at an all-time high from what I can see. And I think all the market signals look that way. So I'm very, very bullish and excited about that. And yeah, I mean, again, I think biased, but I think for smaller like pre-seed funds, it's kind of our opportunity because there's just so much happening there. So it's really more about how do you find the right founders? How do you do the filtering, make decisions to find the ones that you think are going to end up being very big companies? But I'm far more excited and bullish on the whole. That doesn't mean though that there are enough funding options. So it's like YC can double the batch. I would say pre-seed, you're not hearing about this. Pre-seed funds are shuttering at like a crazy high rate because you have the ZERP era where everyone thought they could start a fund, launch a fund, be an operator and have a fund on the side. A lot of those are quietly shutting down, merging, joining other funds. Like there's a lot of that happening. And that I'm, again, opportunistic for those of us who are kind of still standing and still kind of, I guess, have the sadistic mindset to want to keep doing this. But I do think there's a lot of opportunity there.
Yeah.
I know we're out of time. I'll keep it short. I think to Soso's point, I mean, it's for humanity, it's like it's net great, right? More technology equals more progress equals humanity goes forward. And with a lot of things that are happening now, again, there's so many reasons and resources to create and innovate and move people forward. So it's great for buyers, great for people who want to build. Resources, roadblocks have been removed. So I saw somebody's be like, hey, AGI and startups are not great like AI is not great for startups. I'm like, no, it's the greatest thing to ever happen for startups. Doesn't mean it's the greatest thing to happen for VC. And so I do think VC is one little piece of it, right? I think generally I tend to take again, we have very specific ways that we look at things, we underwrite, what we want to see in a seed versus a pre-seed. But yeah, I mean, I kind of alluded to this earlier. I think without question, there's, I think, a lot of excitement around what's out there in terms of the startups, in terms of founders, but a lot of concern, very rightfully, that the VC model as we know it, may not be best suited for what's happening in the world. Many founders, great technical founders, look at solo entrepreneurs and they kind of look at, Peter Levels. They look at things being like, hey, I want to do this, not the other thing. And that, that that doesn't jive with a lot of what's happening in venture, right? And that's a very reasonable thing to do. So yeah, I think as always with any kind of efficient market, you know, the model is going to adapt. The model is going to pick the best people who actually are good at VC, maybe have to do more than they have in the past for founders. Maybe they have to be more creative with economics. Obviously, you know, steeped with bias here, but I think small funds are far better in terms of return profiles. You know, now that I'm positioned to LP, I only look at small funds than kind of, you know, funds of yesteryear. And so, yeah, there's a lot that's, I think, going to change. I think it'd be very naive to think that, you know, you can just run the same playbooks and see success given how much is changing under our feet.
Yeah. Awesome. Good note to end on. Guys, really appreciate it. Let's see if I can get this closer up here. And I think that's it for today. Thanks again. Thanks to Walter. There it is. I got it on the last slide here. And we'll be in touch soon. And anyone who's in the audience, I know you guys are on like LinkedIn and Twitter and stuff, and it was in the email that we sent out. You can bug them. I can't guarantee that they'll respond, but you can bug them. Thanks, guys.
Thanks.
Thank you.
Take care.